Hey traders, welcome to Charts and Coffee. Hope everyone is having a great Friday non-farm payroll morning. Maybe you're flat, maybe you're short, but let's talk a little bit about what we just got in terms of the data this morning and what seems to be the response, because there's actually a kind of interesting response that we haven't seen in some time from some of this macroeconomically important data. So I'm taking a look here at the, let's go take a look at the S&P here. And what I want to show you is probably the first time we've seen the phenomena of what has usually been this usual reaction. And everything's typical and usual until it's not, right? But generally what we've seen is if data comes in and it's a miss, so it's worse. In other words, today's non-farm payroll was categorically awful. It was a miss, higher unemployment rate, lower average earnings. And then also the revision of the previous non-farm payroll was downward, right? So we have that revision there. So all four major headline factors were pretty much a miss. And usually when we have a miss leading up into the rate cutting cycle that we've all been anticipating, usually that sends equities higher because misses or bad news is bullish and good news was bearish. And that's the weird little rabbit hole we sometimes go down into anticipating rate cuts. What is going to compel the Federal Reserve to act sooner? But now that we've discounted a September rate cut fully, this has been fully discounted for well over about 2 weeks now. So there's no question, looking at Fed Fund futures contracts, that there's going to be a cut at the September 18 meeting. We've already passed by that July 31st, and there's no meeting in August. And you might say, Rog, why are we down if the data was just so bad? And the reason for that, and it looks like today's hot zone is going to be that shift. It looks like now finally price action is reflecting the fact that rate cuts are coming. And we had this discussion. A couple of our members in the Sector Secrets Mastery asked about, Rob, what about this recession talk? And talk is sentiment. Now, the reality of a macroeconomic recession in terms of the data is kind of a very slow and almost moot point, because by the time we confirm recession, it's 2 consecutive contractions of GDP, and then it takes the third GDP. Now, mind you, that's 6 months to even get a recession confirmation in the data, and then another 3 months, another quarter to confirm whether we're in it or not. So that's 9 months. And by the time all that's done, it's usually already followed through the cycle. So usually the talk of recession, again, it's more of a sentiment thing. The other part of it is, another question I got in the mastery, which is a really good one, is the conversation of the Fed being too late now what's the dominant narrative? And I'd have to say yes, right? Because when the bad news triggers bearish data, that's distinctly different from what we've seen the prior 7 months of the year. And now with the rate cuts coming, we're seeing the bond yields go straight up, right? Now, why not down? Well, we're expecting rate cuts. So what today really did is shore up expectations for September, November, and December quarter point cuts. So we should be 75 basis points or 3/4 of a point lower in terms of rates by the time we get to the last meeting of the year. Oh, no, that will be the third cut of the year. And that's what today's non-farm payroll is really getting traders to accept, to discount, to force the Federal Reserve into making sure that is indeed the tact. So why so much heaviness? We've been heavy in the S&P and the NASDAQ anyway. July was not a really OpEx forward. From July options expiration forward has not been great for the NAS. And you're seeing weakness even in the 2 stronger indices of the month. Yesterday, the Russell and the regional banks sold off dramatically. And so now we're seeing just broadly bearish action. And by the way, we haven't seen really through July where NAS, Dow, S&P, Russell all move together. It's usually been the NAS moves lower, the Dow moves higher, or vice versa. And then the Russell's been moving with regional banks, and the S&P's been somewhere caught in between what's happening in the Dow and the NASDAQ. But we're starting to see further agreement now in the indices saying, yeah, none of us are happy about this, right? None of these indices are happy about this. And the narrative is going to persist in the Fed's just waited simply too long. And the conversation is going to be the Fed should have cut sooner, even July 31. But that just, again, shores up the next 3 meetings for rate cuts. Longer term, yes. If you're wondering, Rog, let's step away from today. Let's even step away from today's session and into next week and likely the remainder of Q3 and into Q4. Are we going to see strength again? And I would have to say yes, right? I would have to say I'm not going to be bearish on a time horizon that takes us from today, August 2, to the end of the year. I'm just not. Until we have a downtrend, until I see more persistent weakness. And the most bearish index continues to be the NASDAQ. Apple and Amazon did nothing really to change that. When I think about bearishness, here's the NASDAQ. Nothing really happened with Apple and Amazon to say to NASDAQ traders, to tech and consumer discretionary traders that it's time to move higher. But there is an interesting thing that's happening on the NAS that I want to point out. So I guess about 4 years ago, we did a class about volume-based, price-based volume levels, price-based. So it's not about the histogram at the bottom of the chart that you notice I do not use, about how much volume happened today or how much volume happened at 2 p.m. on a Wednesday. It's really about how much volume is sitting at a certain price. So one of the things that we've done, and anyone can do this, I usually recommend doing this on TradingView or any platform that will let you anchor a VWAP. So all VWAPs are not created equal. Most VWAPs are rolling VWAPs, so you cannot anchor it to a specific date. That's where the value of an anchored VWAP comes in, and we've been teaching this for a while. So this is going to be important, so let me just mention it. Take a look at this year. This is the NASDAQ. And we've spent most of the year above the anchored volume weighted average price. Take April out of it because that's where the rate hike conversation, which sounds so ridiculous now, right? But that's where the rate hike conversation started to become more persistent. And equity markets got really nervous because we hadn't seen a cut in March. A cut was not factored into May. And a couple Federal Reserve members whose names were not Jerome Powell started talking about hikes. And that's where that wobble came from. But we got back above the VWAP. So the question is, now, does the anchored VWAP, and where do you anchor the VWAP? So this is what I've been teaching for a long time. Again, most traders use rolling VWAPs. I use an anchored VWAP. We want to acknowledge a certain date forward, and that's going to be the first trading day of the year. Now, there's multiple VWAPs you can put in. If you really want to get more into VWAPs, there are other dates. There are other things we can do. So I could put easily, if you want to say, Rob, where else could you anchor a VWAP aside from the first of the year? You could actually even anchor one to the 19th of April. And actually, you can actually anchor one to the all-time high. If you want to put 3 VWAPs, anchored VWAPs, I would say anchor one to the 19th of April and anchor another one to the 10th of July. But I've got the first of the year, and I always keep that running on my charts. And you can see the NASDAQ's heading towards that. I'm not saying that's going to be a floor, but it's definitely going to be a level to watch because we've spent most of the year above it. And usually if we are above it, that then leads us to think after touching it, we could, or having a little battle there, we could bounce. I'm not trying to pick a bottom. I'm just showing different levels, which could be important moving forward. I'm not talking about today. I'm not even talking about the remainder of August. My time horizon on this daily time frame from a macro perspective is now to the end of the year, right? Now, that doesn't mean that's where the trades are, right? Trades are going to be more along the lines of individual setups. And as far as individual setups go, and I'm just going to talk my book here because, who cares about what we think and what we feel? Rog, what do you have open this morning on Non-Farm Payroll Friday? Great question. So we rolled out of some wins earlier this week that we had some nice wins on the rallies in the moves in regional banks and in Russell. And those got stopped out yesterday at break even or first targets because we're managing our trades, right? We're not just keeping that risk-based stop in there. So we got stopped out of those, which is fine, right? take profits when you can, not when you have to, right? That is my mantra. Also, when a market's moving against you and has exceeded or reached the threshold of allowable risk to your account, what a concept, right? We've got to just cut the trade, because we have an acronym that we avoid in the Sector Secrets Mastery. We never add. Add is an acronym, if you didn't know, in trading land. It's called actually, delusion, and denial, right? Why not just say, hey, this trade is not responding in a way that I expect. Let's just take a small loss. One of our members in the mastery, I love this, Jason, shout out to Jason. He said, Rog, we got to kill the monster while it's small. That's true. We don't feed the monster and make it bigger. So that said, Rog, what do you got going into Friday this morning? What did you see fit to hold into non-farm payroll? Well, it's actually 3 trades that we're already in. Long healthcare, we've already scaled out of that one. Long utilities, because it's a defensive and it's been a strong outperforming sector. So we're long XLU. Now, if you're looking at XLU, there's a number of stocks within XLU that look good. But when there are enough stocks in a sector that are moving higher, we play the tide and not an individual boat. But there's a lot of strength in utilities. NEE, Southern Duke, Dominion. There's a number of them. So we just said, look, why not just take all of that? Why not benefit from all of that strength and be long XLU? All right. And then the last position that we have long into today's Coke. Coke punched up to new highs, and we're continuing to manage this winner. In other words, a winner is something where we've hit the first target and then we've begun to manage our risk by going to a break even. So those are the 3 positions that I have going into today. And I firmly believe that for sure, XLU should benefit from just the concern. It's a defensive. It's where money goes kind of to hide out. And if staples are also going to benefit, one of the best trends in staples is Coca-Cola. So go figure. When everyone's scared, they go grab a Coke. Maybe now they're throwing a little rum in it. I don't know. But Coke is definitely benefiting from some of that concern. And staples and utilities are benefiting. And you can see that in those sector relative performance. All right, so let's get to the questions. As always, first up, asks NQ, sure. Daily 18,306. I don't focus on exponential moving averages as much as I used to. Once we started getting a lot more algorithmic type influence over the market. And this happened about 3 years ago. We really started seeing a lot more algorithmic influence. We started shifting away from 200 exponentials or even 200 simples, which are only price-based. And we started to modify the way we look at where those levels are on a 200 period. Mine is way down actually at 17.7. I'm not looking for a price to get down there. It's got to get through the anchored VWAP and 18.5 first. And, for those of you that are wondering, actually, let me do this here real quick. We have something called the sanity check. And the sanity check is something that we look at to understand where price action is in perspective to pullbacks from the highs. So if we're going to see a 5% pullback, that's come and gone. If we're going to see a 10% pullback, that's come and gone. A 20%, which is the markets in turmoil special Q, that's not until 16 and change. So we're really just hovering just below a 10% pullback. All right. But we're still above the anchored VWAP, anchored to the first of the year. Right. So no, I wouldn't be looking that low. I'm going to stop at the anchored VWAP first and see what happens. So thank you for the question. All right. John asked, is the rate cut already priced into stocks? Yes, September is. And I would say as of today, John, so is November and December. And I'm not saying that from some gut feel. We go right back to the data and we look at September fully baked in. In fact, wow, September as of non-farm payroll. Wow, gang, this is really interesting because you need to give the Fed Fund futures about 30 minutes after non-farm payroll to really get a good read on the target rate probabilities. And we now have a 0.5 point cut now starting to be baked in for September 18, which is the equity markets, the treasury markets, the currency markets, all saying, Jerome, you should have cut in July. So now you better play catch up and give us that half-point cut, because non-farm payroll, unemployment, the revision, it's awful. You're too late, right? You took too long. So now, because you took too long, you better pick up the pace. And that's what September is showing here, 30 minutes, 45 minutes after non-farm. That pushes then all the expectations for rate cuts to maybe a full percentage point by the time we get to, by the time this is now fully discounted, half point cut, quarter. Now, granted, we have so many more non-farm payrolls to go. We have so many more PCEs and CPIs. We have GDP coming up this month. We have a lot more data to go. But with what we know right now, this is what the Fed Fund futures are just yelling and screaming about at Powell, saying you should have cut, you waited too long, and now we want to see a half point cut, a quarter point cut in November, a quarter point cut in December. And these are fully discounted now, gang. This is a fully discounted scenario, not the half point cut, 3/4. And now that half is starting to gain a lot of traction. And again, go right to the data. All right to the data. All right, next up is what sectors will I be eyeing given the current market structure? Ren, I'll tell you, it's not even a matter of eyeing. What I am in now, what the Sector Secrets Mastery folks are in right now. Healthcare, which is actually holding pretty steady. Healthcare, utilities, and one stock in the staples. So we've focused really on a lot of defensive, not only because they've been outperformers in July, but because if there is concern, staples will benefit. And if the trends continue, staples and utilities will benefit, right? So that's exactly where my book sits, is exactly what we're doing. Yeah. And look, in Charts and Coffee, admittedly, I talk my book. But frankly, I don't, if I want to talk about people hypothesizing about positions, I'll turn on television, right? If not, I think it's really important. I tell you, this is what we're doing. These are the open positions, and these are the trades we're managing. All right. Next up is, let's see. What is, Christopher asks, I'm new here. Welcome to Charts and Coffee. We're here every morning, 9 to 9:20, Monday through Friday. Why the market's selling off? Disappointing jobs numbers that are just absolutely screaming and yelling at the Federal Reserve, at Powell and company, that you took too darn long to start cutting rates. Because remember, the Federal Reserve has a dual mandate. What does that mean, Rob? They have two jobs, not just the inflation target. They've got to get to the inflation target while not destroying the jobs picture. Today, we got the Jerome, your second mandate, that employment mandate, you're screwing up. You're taking too long. The monetary policy is lagging behind reality. That's the message the market's giving Jerome and company today. And you can see how the target rate probabilities, what they're now suggesting strongly that Powell will do to make things right is definitely cut a quarter point at the next 3 meetings and possibly give us a half point cut in September. All right. So we got some recommendations for bourbon and some rum. All right. What do I make of the real estate and banks selling off hard, even with the rates going down for the Fed move? John, remember that in terms of XLRE and ITB, I would keep an eye on ITB. The ITB narrative should not really be upended too badly, because if rates go down, mortgage rates go down, and that distinctly, obviously benefits home construction, home builders, ITB, XHB. And the other thing we have to remember is risk aversion, this desire not to have stocks, not to have that optimism around growth stocks and high beta names. ITB could get swept up in that for a little while. I'd keep an eye on ITB and XHB. Maybe not today, but once the initial sell-off starts to wane, and it already is, by the way, it's already starting to take back the non-farm payroll sell-off, because the reality is jobs are awful, right? Let's respond to that. Let's react to that. Let's communicate to the Federal Reserve what we think. And then I'm still bullish. I know, not everywhere. It doesn't mean I'm buying. Remember, again, bullish and buying are two different things, but I'm still bullish. It's hard to be bullish in this heightened expectation of rate cuts. And it's just where the trends are going to shift. And that's why we're focusing more on names that are outperforming, sectors that are outperforming in the Dow, and then staples and utilities. All right. So, gang, that's it. Thanks as always for being here for Charts and Coffee. my Sector Secrets Mastery folks. I'll see you in just a moment. And for those of you that are curious about what we do in the Mastery, so just to give you an idea what I'll be doing later this morning is every morning between 9:30 and 10:30 for 1 hour, I focus on where the day trading setups could be. And then from 10:30 to 11:30, we focus on the swing trades. So every morning, if you're thinking, Rod, I want to day trade for a little bit, 9:30 to 10:30, and swings 10:30 to 11:30 Eastern. All right, gang, I'll be doing the free video tonight at the Simpler Trading YouTube website. So if you want to check out ultimately what we've taken from today's action, check it out today. It'll be posted shortly after the close. In the meantime, have a wonderful weekend. Manage the risk. And I will see you all on Sunday at 6 p.m. for the top tier outlook as we prepare for the fresh week. All right, gang. Be good to each other. I'll talk with you soon.